Good day. Welcome to the Macro Anchor Podcast powered by the Prague Finance Institute. I'm André Chelot, Chief Economist of the Prague Finance Institute. Our podcast is planning to do regular interviews with prominent macro and international economists and geopolitical strategists to understand the ongoing developments in today's world economy. We welcome today a very special guest, Mr. Neil Shearing, Group Chief Economist at Capital Economics, Associate Fellow, Global Economy at Chatham House. Hello, Mr. Shearing. How are you?
Hi, Andre. Good to be with you.
Very nice, Neil. Good to see you too. I would like to ask you some questions about what's going on in the Eurozone economy and the UK economy, knowing that capital economics is very involved in these countries and they have a lot of expertise in what's going on. Let's start by the Eurozone. What is your take on the recent political developments in Germany? Will the country succeed in forming a new and stable government or a coalition government?
Well, take a step back. The political dynamics across the Eurozone are getting incredibly difficult. There's national politics, and that's not just in Germany, but also in France as well, where we've seen challenges. And then laid on top of that, we obviously have the re-election of Donald Trump, which we can get into. But by the looks of things, tariffs coming down the track, a greater focus on bilateral trade imbalances in the US. Europe obviously runs, and Germany in particular runs a large surplus with the US, so potentially coming under the firing line too. So really difficult set of political and geopolitical issues for the Eurozone to deal with. Ukraine as well, by the way. And yes, you're right. Governments fraying. The backdrop too, of course, being fiscal strains. There potentially being less money to throw at problems. Now, as it relates to Germany, we've got elections in March, as you know. Government probably won't be formed until the summer. A whole load of things can happen between now and March at the risk of stating the obvious. The critical thing, I think, there's several critical things. Well, one critical issue is the performance of the CDU, the performance of the AfD. Obviously, most of the mainstream parties all the mainstream parties have ruled out entering government with AfD. But the question is, to what extent will they detract from pull votes away from the main centrist parties? And then will with the CDU, if it is indeed the CDU that get the largest number of votes, will they go into government with the Social Democrats or the Greens? So there's a whole load of different and a whole heap of different ways and political configurations here. I think one of the key points in all of this, bringing it back to the macro, is that it was the debt brake that undermined the last governments, led to the demise of the last government, and this crazy idea that you end up with kind of pro-cyclical fiscal tightening. The German economy is weakening, and because it's weakening, revenues are falling or are softening, and because revenues are softening, the debt brake mandates you to tighten fiscal policy. That kind of counter to everything we know about the way that macro policy should be run. If we end up with a government that takes a slightly more, if not relaxed approach to the debt brake, perhaps reformist approach to the debt brake, and tries to change that, then I think that's, in the long run, a good thing.
Okay. Well, we see that as you mentioned, the German industrial sector is in trouble. Mm-hmm. But how do you explain the resilience of the service sector?
Well, look, I think when you look at what's happened to the Eurozone economy over the past 2-3 years, that we have seen what I would describe, for want of a better word, as a weird cycle. We had really strong demand for manufactured goods through the pandemic, the world being locked down, everyone being at home, buying the type of consumer goods that are made not just in the Eurozone, but also Asia, surge in demand for manufacturers. Then the so-called revenge spending. Once lockdowns were lifted, we stopped buying manufactured goods and went out and bought services. So we end up with these kind of cycles that were moving at different speeds and in different ways, where normally the manufacturing and services cycle tend to move together. Now, fast forward to today, manufacturing, I think in Germany in particular, is weak, not just for cyclical reasons, but primarily actually for structural reasons. The energy shock that followed Russia's invasion of Ukraine has really, I think, accelerated structural decline in key parts of German industry. And then, of course, there's the particular challenges facing the vehicle industry and the fact that they're at least 2 or 3 steps behind it when it comes to the EV, the electric vehicle revolution. Services, on the other hand, when we start to look at the kind of fundamental driver of services activity, which is the labour market and the strength of consumer spending, I mean, it's not great, but it's not disastrous either. Unemployment still incredibly low, labour market's tight, real income growth starting to return now that inflation's coming down. I think all of that is still giving a bit of support to services, even though we've got this incredibly weak industrial sector, particularly in Germany. And then it's also important to look at things not just at an aggregate Eurozone level, but also at a country level. And if you look at what's happening under the hood, services have been particularly strong in countries like Spain. And a lot of that has to do with, a very strong domestic economy, but also strong tourist sector.
What would be the impact, since you talked about it a bit, the Trump tariffs on the auto industry and other industries? What we are talking about here?
Yes, I mean, this is the big question, isn't it? To what extent will a Trump presidency transform the prospects for the Eurozone? I think by and large, actually, there's a lot of sound and fury about the impact of a Trump presidency and what it might do to global trade and GDP and inflation. And there will be some impact. But I think if we're looking for the effect of a Trump presidency on Europe in the GDP numbers in 2025, we're looking in the wrong place. Right. Yeah. The really big effect of the Trump presidency, or the consequences of the Trump presidency, is going to be in pressure to increase defense spending over the long term. The consequences for NATO, consequences in terms of continued support for Ukraine, reshaping the narrative around US-China fracturing into a slightly more perhaps broader pushback against global trade. These are all big long-term trends that will play out over many years, and it's not going to be seen, the effect's not going to be seen in trade or GDP next year. Now, when it comes to tariffs, the big question is really, do we see at what levels will they be set and on what products? And we've seen various things talked about on the campaign trail. 10% universal tariff has been proposed, 20% in some cases, universal tariff. If it's 10%, if there was a 10% tariff on all US imports from the Eurozone, to give you a sense of what that does to Eurozone GDP, we think it knocks about 0.1% off of Eurozone GDP. So it's not nothing, but it's pretty much a rounding error in the grand scheme of things. So I think a 10% universal tariff, once you factor in some currency adjustments, some retaliation, I think 0.1%, that's not a big deal. Like I say, I think that the bigger effect, the bigger consequence is in what it does to reshape the global narrative around trade, what it does to reshape the global narrative around kind of multilateralism, or at least regionalism, which I think will change. And these are all big long-term themes and issues.
I agree with you. Let's move to another worry that is facing the Eurozone, which is the French debt. It is at 110% of GDP. The deficit is at 7%. And I'm going to combine this question with another question. Do you think that the Eurozone countries will return to the 3% deficit rule?
Well, I think if we're expecting the Eurozone countries across the board to return to the 3%, the limit of 3% of GDP as a fiscal deficit, I think that's a triumph of hope over experience. I don't think that's going to happen anytime soon. You mentioned France, your deficit large, debt burden large, a government that's desperately trying to push through some fiscal consolidation. It remains to be seen how successful that will be. But really, it's not just France. Italy, the fiscal position is looking increasingly worrying too. So deficit there, 4.5% of GDP. It had been as high as 7% of GDP. Now some property tax relief has expired. The deficit's come down, but obviously the debt burden in Italy high too. And this is an economy that doesn't tend to grow much more than kind of 0.5% a year on average over the long term. So when we look across the Eurozone, across the 3 major economies of the Eurozone, France, Germany, and Italy, Germany, the problem is that fiscal policy is too tight. We just talked about the debt brake. It should be relaxed. The policy is too tight. There's capacity to loosen fiscal policy and generate some growth, which is the German economy and Eurozone economy needs. And in France and in Italy, it's the exact opposite problem. The deficit's too big. The debt burden looks unsustainable. It's going to continue to rise. And this, I think, is the great tension at the heart of the Eurozone economy, the divergence of fiscal positions. Over in the first 10, 15 years of the Eurozone's existence, we had private sector imbalances and emerging big private sector debt booms in places like Spain, funded by surpluses in Germany. Now, I think the issues, the divergences are principally on the fiscal side, the public sector finance side. It's very difficult to say exactly when these issues crystallize. We know that bond markets can run out of patience quickly. Equally, they can tolerate large deficits and large debt burdens for a long time. But to my mind, this is the greatest challenge facing the Eurozone on the macro financial front over the next decade. And it's not just common to the Eurozone. We look at the UK, we look at the US. The fiscal positions there are pretty grim too.
This is a question that's being asked actually in the markets. Will we have a European debt crisis again, or will the euro itself succeed with all these political developments and the divergence in debt, in public debt between the countries? What do you think? If we take a bet, long-term bet.
Well, over the long term, I think it's inevitable that every country will have some form of crisis at some point. So the idea that the Eurozone's problems are somehow solved and challenges are somehow solved because of institutional changes made in the wake of the last crisis, I don't really buy. But I don't think those kind of challenges are necessarily unique to the Eurozone. As I say, the fiscal trajectory in the US is equally troubling. I think what makes the Eurozone different and what marks it out as different is its institutional structure. Monetary union that's incomplete, fiscal union that's certainly incomplete, banking union that's barely got going. And so what this means is that the mechanisms to resolve debt crises as and when they emerge are not there. It might be the case that Europe as ever is forged through crisis, and so maybe the next crisis does lead to the developments of the kind of full-throated fiscal union and banking union. But I'm pretty skeptical that's going to happen, to be honest. So I don't think the Eurozone is necessarily going to fall apart overnight, nor indeed do I think it's going to experience a crisis overnight. But I do think we're going to have this kind of constant over the next 10, 20 years back and forth of concerns about crises and institutional structures and so on and so forth. It's not going to go away.
Yeah, I do agree also. On the UK then, moving to the UK, if you may, we have some few questions for the UK economy. I saw in the UK a resilient economy, and the central bank tightened monetary policy, and it seems that the UK economy is withstanding these shocks. How come?
Well, I think some of it depends on how close you are to the UK economy. If you ask the average UK consumer, how have you felt over the past 3 or 4 years? The answer would be, well, it's been pretty grim. There's been this big shock to real incomes. Inflation, I think, is a problem everywhere, but particularly in the UK, the kind of legacy of inflation, the sense that of scarring created by inflation. We've just had an incumbent government kicked out and the Labour government come into power with a huge majority, so a landslide victory, which I think reflects the sense of kind of dissatisfaction amongst the UK electorate. So, again, when we look at GDP, we've had this enormous monetary tightening. It's not really driven the UK into a recession, but it's felt pretty grim for UK consumers for a while. And when you look at the economy's performance since Brexit, dare I say it, it's been lackluster. Okay, it's not been quite as weak as Germany, but it's not been much better. And it's certainly been far weaker than the US. So long term, the UK economy is not in a great place. The question is why? How much of it is a legacy of the global financial crisis, the slow recovery from that, and then the added challenge imposed by first fiscal austerity, which in my view was unnecessary to the extent it happened in the UK in the wake of the GFC, and then Brexit, which was, I think, any which way you cut it, an economic shock and has dragged down on long-term potential growth in the UK. So how much of those are factors that have weighed into it and this weak performance of the UK economy and will fade over time, versus how much is it a permanent structural reduction in the long-term path of economic growth in the UK? And I think it's partly a bit of both. My sense is that over the next 5 years or so, the growth performance will be better than over the previous 5 years. But the idea that we're somehow going to return to pre-GFC rates of growth, that many people are kind of starting to talk about, growth budgets in the UK, I just don't buy.
Well, now that we had the Labour government, the first one in 14 years, I think, and we had their first budget, it seems to me that there is a shift in fiscal policy. First of all, the budget deficit is projected to be lower than the one last year. So that is a contraction on its own. But it seems that the fiscal policy is shifting towards more taxation and more investment. And this might allow the central bank to have a more aggressive approach to monetary policy easing. What do you think about that?
So I think there's several things happened in the budget, but fundamentally it came down to a judgment. The government had to make a judgment. Do we, the fiscal plans they inherited from the previous government imposed or envisaged this enormously tight contraction in real government spending over the coming years? And the question they faced was, do we think this is plausible? If not, how do we finance it, and how do we protect investment? Because there's a time-honoured tradition here in the UK of, as soon as there's any fiscal contraction or repair work to be done, is always public investment that gets hit, and the consequence of that is plain for everyone to see who uses the UK infrastructure system on a daily basis, right? So I think the judgment the government has really made is the spending plans they inherited were not really sustainable. So we've seen an adjustment there. Some of the spending cuts pared back. More money made available for investment, so investment doesn't get hit so hard. But the flip side of that is that the tax burden has to be higher by definition. Otherwise, the deficit's going to be greater. And this actually is something we've seen across Europe. It's not just a UK phenomenon. The tax burden post-pandemic is going to be higher, I think, than it was pre-pandemic. I think there's a reckoning coming for public finances. We've just talked about large government debts and deficits, and there's a danger in tightening policy too quickly, particularly when economies are weak. But over the long term, those deficits have got to come down. And if you can't get them through growth, it's got to come down through either spending cuts or tax increases. I think there's some case to be made for some of it to come through spending restraint, frankly, but it is I think, easier for governments at this stage to do it through tax increases, which I think the tax burden is going to be kind of edging higher over the coming years.
Now, to turn into monetary policy, does this shift on fiscal policy will affect the monetary policy?
I think it does. I think what it does is that for a generation, central banks didn't really have to think about fiscal policy when setting monetary policy. Fiscal policy was just taken for granted that governments would set policies that was broadly neutral over the cycle, and central banks could get on and worry about other things, set policy according to other objectives. Now they've really got to think, in my view, about what the direction of fiscal policy is. We're in this era of larger deficits, and all other things being equal, that pushes up the neutral rate of interest, the neutral real interest rate. So we're in a world where the neutral real rate is higher because fiscal deficits are larger, and so that plainly has an implication for monetary policy. And what it means is that rate cutting cycles have started across advanced economies, including in the UK and the Eurozone. But I would be shocked and amazed if we get rates anywhere close to the low levels that we saw in the pre-pandemic era. They're just simply, I don't think, going to go back to those rates. We've got to get used to a world where real rates are higher and nominal rates are higher. And in the UK, that might be 3.5%, something like that. In the Eurozone, it might be 2%, something like that. But we're not going back to the kind of zero rates environment.
Okay, Neil Shearing, Group Chief Economist at Capital Economics. Thank you very, very much for coming to our podcast. We hope to see you again and have a good day.
Thank
Thank
you. Thanks for having me, and I'd be delighted to be back.
Thank you so much.